Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of June. Now, we're just coming off a hot May. May's typically not as strong as what we saw. In fact, the S&P 500 up 6.2% in May. That's you have to go back to 1990 to get that type of return, a stronger return. Now, typically, the May starts off a weaker 6-month period for the stock market, but what we saw was the reaction to the market after the self-proclaimed Liberation Day in early April. We saw the market bottom shortly after that when it looked like the tariffs were on pause, et cetera, et cetera. And we saw the market rally strongly. Now, it's mainly been retail buyers buying this, and we've seen a big short squeeze as well. So the market's moved up higher in April, and it just continued on in May, basically. And we've seen the expectations from investors that this tariff situation will get resolved somehow favorably, whether they go back to what it was before, or single digits as far as the overall tariffs that the U.S. will be applying. But there's optimism around that. We saw that carry into May and very strong performance. I'm not convinced that June's going to be as strong here at all. I'm going to go over that. First of all, on a technical basis, we're starting to see the market roll over a little bit. June tends to be one of the weaker months of the year as well, more so than May. But the good news is we can see a buying opportunity take place later in the month as we head into the Q2 earnings season, which kicks off in mid-July. So it's after typically a weaker June, towards the end of the month, we start to see a good buying opportunity. So that's on a positive note. Today, I want to take a look at what sectors are moving right now. What are some of the variables as well? What's happening in the bond market? What's happening with interest rates? Go through that scenario. Then I want to take a look at my last book and take a look at the seasonal trends. What tends to be hot in the month of June, sector-wise and stock-wise as well. We'll pull up some of the charts and we'll take a look and see where they stand right now as we go through that. So let's start by taking a look at the sector performance last month as well, and we'll take a look at some of the major markets' performance. Okay, so here we see the S&P 500 up 6.2%. The strongest market here sector was the technology sector. This was really risk on. There was the growth sectors that did well, and industrials. And the general feeling there from investors was as the situation was getting resolved from the tariffs faster or better than expected, that this sector was going to be a big beneficiary. Healthcare down. So generally speaking, the defensives didn't do that well. But look at some of the others. Energy really was weak. Materials even was quite weak. Now, we'll talk about gold in a second here, which is part of that as far as the U.S. goes. Financials, only up 4.5%. A lot, but not as high as the 6.2%. If we take a look at some of the major markets, NASDAQ up 9.6%. That's almost 10%. So this really was a risk-on move. Now, the interesting thing is we didn't see the small caps. They've just been getting hammered consistently over time. We haven't seen that real pickup for small caps, well, really in a couple of years here. TSX was up solid, not as much as the S&P 500. Europe taking a backseat, China taking a backseat, emerging markets overall. It really was all about the U.S. market in the month of May. Risk on and into the growth sectors and technology. If we take a look here, we can see this being reflected in some of the subsectors. Semiconductors up almost 14%. This was a surprise for me. Retail up 10.5%. Retail typically has a strong seasonal period in April, but not May. I'm not convinced that's going to hang on here. We're seeing some really weak data with consumers overall. We'll talk a little bit about that. Home builders was down 0.5% in the month of May as well. We're starting to see some weakness in that sector. Gold, a lot of people have been following gold, flat for the month. So we saw that record high in April, and we've seen some trading back and forth here. So gold has given up a little bit of ground. Overall for the year, it's still up 25%, but we have seen that correction. Typically May tends to be weak for gold. June tends to be weak for gold as well. In fact, it's one of the weaker months, but the next seasonal opportunity starts in July. And typically, if you see some volatility in June, it can represent a good early buying opportunity. So we'll have to watch for that. Last month, there was a lot of focus on government bond yields in the U.S. They weren't up that much, just a little bit, but they were really moving around a lot. We'll talk a little bit about that in a second. And in Canada, we actually saw the yield on the 10-year increase as well. So we're seeing bond yields 10-year longer increasing in multiple countries. And that's a little bit concerning. Well, we'll take a look at another graph showing that in just a second. In April, we saw the Canadian dollar do well relative to the US dollar. And then we saw in May, the Canadian dollar actually do well again, once again. Typically, you start to see a little bit of fade in May, but the U.S. dollar is really getting hit from around the world here overall. It was down just a little bit in the month of May as well. So we're seeing some overall strength in the Canadian dollar, which is interesting considering that we have seen some weak performance from the energy sector at the same time. So if we take a look at the S&P 500 here, we can see that bottom I was talking about in April. We saw that strong rally for the S&P 500. We haven't gone back to the all-time highs that we set back in February, but close. Now, the TSX in Canada has actually reached all-time highs just recently. But if we take a look at the price momentum, RSI became oversold and is trending down. We saw the same with the full stochastic oscillator. I want you to take a look at the PPO, which is really a normalized MACD. If you take a look here, we can see that it became very overbought, and we've seen that crossover. Now, if we go back, we have to go back really to 2022 to see the same type of magnitude where it became overbought, and then we saw a crossover. And when that happened, we did see the S&P 500 correct a bit here at this level. So we are seeing consistent signs of price momentum starting to decline. Now, actually, the market's had a really strong run, and perhaps it's become overbought. We've seen tariffs on, tariffs off, tariffs on, tariffs off. But right now, the expectation from investors are that this is all going to go away somehow, and that's why we've seen some of this strong run here. I want to show you this graph because there's a lot of talk about the yields in the U.S. at the long end increasing, but it's not just the U.S., it's Germany, it's the U.S., it's U.K., it's Japan, and we've seen this general trend over the last few years increasing for these countries. If we take a look at the 40-year on the Japanese government bond, you can see here that here's zero down here. We got close to zero in 2019. We've seen it upward, and look at this. We've seen that spike recently. And this is we're seeing record-setting highs for yields now. Their debt to GDP is at around 230%. Absolutely incredible. Now, they've been able to get away with having a very high debt to GDP, government debt to GDP, because they're a country of savers and they have a huge trade surplus. So it's very different compared to other countries such as the US or Canada. And what we're seeing in this market here, it's interesting to see what's taking place here because we're seeing inflation start to tick up higher. Now, the Bank of Japan owns 52% of their government debt. I don't call that a free market, but at some point, investors are going to really come after them, and we're going to have to see if this is the time because this increase here is quite concerning. The Bank of Japan also owns 75% of the ETFs in Japan. Just absolutely incredible. And there's concern that with the rising rates around the world, the investors are starting to say to governments, you guys are spending too much money. You need to cut back. And governments just are not showing signs of that happening. We'll have to see if that's actually taking place. But that's been a little bit of a concern recently with huge expenditures from governments. I do want to point out this relationship here between the US dollar and the yield on the 10-year treasury note. Yeah, you can see here that they've generally moved together. And here's Liberation Day in early April. You can see that this has gone their separate ways. US dollar has headed lower relative to world currencies as the yields go higher. And this is really being caused by, and there's a lot of talk about what's going on with this. This is being caused by basically foreigners selling off their positions, flipping the currency into their own currency and redomiciling the currency back into their home country, basically. And foreigners own huge amounts of U.S. stocks and bonds as well. And we saw this before. We saw this back in the year 2000 when the market initially turned over. And we saw it in the great financial crisis as well initially. So despite the U.S. dollar being a safe haven asset, investors were selling the U.S. dollar at when we saw in the start of the great financial crisis and also in 2000 as well. So we could be seeing the same thing taking place here. It doesn't mean it's going to continue, but it's going to be something to watch out for. I want to show you this graph here. This is corporate profit margins. And you can see here that basically historical average all up until 2000 was around 6%. In fact, Warren Buffett said that, it's very difficult for corporate profits to remain above 6% for a long time, because competition will come in and take them away. But what we've seen here is, we've seen, for a number of reasons, we've seen an increase in corporate profit margins, partly because of the structure of business has changed. We've got a lot of tech oligopolies, which demand higher profit margins. The government printing a lot, government combined with the central bank printing money, which caused rapid inflation, and companies basically raised their prices. And they kept going even when inflation was dying out. So with that, we saw profit margins increase. So here we are, really close to all-time record highs for the profit margins. Lots of discussion about who's going to eat the cost of the tariffs. Actually, I was on BNN Bloomberg talking about this the other day, and a lot of it has to do with the elasticity of the products being sold into the U.S. But right now, initially versus longer term, are different. What we're finding is the Chinese are actually, from China, they're actually, the Chinese companies are actually eating a lot of the cost for the tariff. As well, you're going to start to see U.S. companies eating the cost of the tariff as well, because they're at this really high profit margin. And so they can do that. And the U.S. consumer will also bear some of that burden. So there's really three different distributions for the eating the tariff, let's say. Over time, you're going to find that when competition comes in, it will be borne by the consumer over time. But right now, it's really a lot to do with China, a lot to do with the U.S. companies as well, because they have the room to do it. And this is, you typically see profit margins head lower into going into recessions, because companies cut their prices. And they've got some room at this very, very high level to do this right here. But if we take a look here, we can see the more up-to-date data. We're starting to see corporate profits actually decrease here. And that's actually a big drop. We have to go back many years to actually see that type of drop. So that's more recent data saying that corporations are starting to suffer. Perhaps they're trying to eat some of the cost of the tariffs. A lot of them front ran the tariffs and imported a whole bunch of product. But nevertheless, there's still product coming in with tariffs on it. And companies haven't adjusted their prices yet. And that could be tough, because consumers are starting to show some wariness as far as high prices. And there's a lot of concern, troubling signs as far as the ability for consumers to pay, whether it's credit card delinquencies, repossession rates, a whole bunch of different factors as well. So we'll have to watch out, because what does lower profit margins mean? It means lower corporate profits overall. Which basically hurts the PE ratio. It's the E and the PE ratio, so that could put some strain on stocks. Okay, let's take a look at some of the seasonal trends for the month of June, what we can expect from a seasonal perspective, and we'll take a look at some of the stocks and sectors as well. Okay, so here's my Thackeray's 2024 book. So I want to point out that for the month of June 1950 to 2022, here you can see on average, we tend to see a little bit of a positive run at the beginning of the month. I'm not so sure that's going to happen this time around. We'll have to see. On Friday, just before June started, we saw Trump come in and introduce a whole new set of steel and aluminum tariffs, also threaten China as well. So the tariff war is not over yet. But on average, we do see the month of June start off on a positive note and then really head lower until later on the month. And then we start to see this uptick happen here on average. Now that sets off into the beginning of July. The first half of July tends to be positive heading into earnings season as well. So that's really where we could see a positive opportunity. Here we can see we actually see some, on a frequency basis, some days later in the month actually tend to be negative, coming into that last end part of the month that could be an opportunity. If we take a look at the ranking for June here, it's the 9th best month for the S&P 500, for the Dow Jones 11th, NASDAQ 8, TSX Composite 11. So it's not one of the better months of the year on average. Now, this is interesting. If we take a look at the sectors that tend to do well in June, the healthcare sector, it tends to be, on average, one of the top performing sectors. So these sectors are ranked according to their average gain all the way down here. And in this column here, we have the frequency of outperforming the S&P 500. The healthcare sector has just been getting killed. A whole bunch of negative announcements for the healthcare sector overall. Company announcements. That sector has just been definitely a lacking sector. After starting the year on a very positive note, it has really lagged. Telecom tends to do well. Information technology, but look at the frequency. It tends to be low. In other words, when it's got positive momentum, like it does right now actually, it can be one of the better performing sectors if the month is positive. As well, consumer discretionary. If we go down here at some of the weaker sectors, materials, financials, this is one of the weaker months for the financial sector. Industrials tends to drop off here a little bit as well. Energy, tends not to be a great month for the energy sector as well. The energy really has been showing some signs of weakness. Now, I want to say it does have a strong seasonal period coming up in late July. And typically when we see some weakness coming to that can be a good, strong seasonal period. So we'll have to take a look. Okay, if we take a look at this Costco, buy at a discount here, May 26th to June 30th. So this basically a month. It tends to be do quite well, perform quite well. And you can see here it's got a fairly strong performance on average, 72% of the time positive, 4.4% average gain. If we take a look here, we can see that June here tends to be positive. And if we scoot over here and show the month-by-month basis here, June. Now, there's other times of the year where it can do well, but June actually stands out quite positive. Let's go back and take a look at Costco here. Costco's done extremely well over the last few years, and it's outperformed the market quite solid. If we go back and take a look at the month of June, really it was, it's positive in the month of June and performed about market in 2024. And likewise, it's positive and about market as well. If we go back to 2022, we can see here that 2022 was a negative year, so some of the defensive sectors and Costco actually did quite well here, was positive and outperformed the market again. So it's a brief period here. We are starting to see a little bit of an uptick here. They came out with some earnings the other day, and investors liked what they saw. We are in this a little bit of an uptrend, so we could see Costco still move higher. I think you have to see a fade from the technology stocks and the growth stocks for Costco to actually perform well at this time. Okay, here's Oracle. Oracle tends to perform well in the month of June. Look at this solid performance, 74% of the time, 7.3% average gain. Here's June right here, like the CN Tower, okay? Average way up here, median as well. Tends to be strong. Frequency, but better than zero, 70% of the time. Better than the S&P 500, 79% of the time. So let's see how it stacks up and what's happening now. Okay, so let's go back and take a look. Here's 2024. Very solid year in the month of June. Strong outperformance relative to the S&P 500. Once again, strong outperformance. A lot of up and a lot of down, but outperformance. We go back here and take a look here. It was fairly flat, but how did it do relative to the market? Outperformed. So outperformed. Okay, this is a little bit of a concern, the fact that it's actually bottomed a little bit early here and had this really strong performance coming into June, which is quite a solid move here. Nevertheless, we still could see Oracle do well. We still see that upward trend here. It has become overbought and turned down a little bit. I'd probably be a little cautious on this one at this time, despite the strong seasonal period. Okay, let's take a look at Biotech. Biotech can have a strong run coming up in late June into mid-September. Now, the bulk of that run usually happens in July, so July is really the month you want to focus on. Okay, so here we go. We've got the S&P Biotech from June 23rd to September 13th. Very strong performance. Average gain of almost 10%, 77% of the time being positive. And if we take a look here, July tends to be the month to focus on. Average and median tends to be quite strong, and performance relative to the S&P 500 is 77% of the time outperforming. Now, biotech has not had a good run over the last couple of years. Okay, here's IBB for the biotech and the IBB relative to the S&P 500. If we look at an absolute basis, it's gone nowhere over the last few years. And the sector has been underperforming over the last few years since 2023 as well. But let's take a look at the month of July. So July is typically where it tends to do well. It usually starts in late June as well. Relative to the market, we can see here it was actually down here despite this upward trend. And if we come into July here, slightly negative. July outperformed here. And here we are continuing to go down. So this is one of the advantages of seasonal investing. Here we are in this downtrend. And rather than being in the sector all the time, yes, you would have been fairly flat here and down here a little bit, but you would have outperformed here. But you would have missed a whole bunch of this other time as well. But we'll have to see what you're looking really for. It would be ideal if we did start to see this become oversold here, which would represent a good opportunity. Usually starts in late June. We'll have to see what happens this time around. Okay, let's talk uranium. Uranium is in the news. We saw uranium stocks last week just go on a tear 2 weeks ago. At the end of the week, when Donald Trump announced some executive orders and really helping the industry out, we saw this big, huge pop higher for the uranium sector. And I got to tell you, longer term, I love uranium and I love nuclear. I think it's going to do really well. But there is a seasonal element to it as well. And right now we are entering into a weaker seasonal period for the uranium sector. Let's take a look at Cameco. Okay, so let's take a look at Cameco here. It's got its weaker seasonal periods from June 5th until August the 7th. This sets up before we see the World Nuclear Association conference. It typically happens in early September. But in this time period, Cameco tends not to perform well on average. From 1995, it's actually been negative, and it's only been positive 39% of the time. That doesn't mean that it will be this time, because there's a lot of strong fundamental factors taking place for the uranium sector, and it's got a good long-term picture. But this tends to be a weaker time. And the sector's really been driven by short bursts of catalysts and then pausing. So we've seen a run recently, and we might see a little bit of a pullback. Let's take a look, though, at before we go take a look at Cameco and how it's doing. But you can see here June tends to be a weaker month, and July. So June and July are the two weakest months of the year on a median basis for Cameco since 1996. And if we take a look, outperformed for June, outperformed the S&P 500 since 1996, 30% of the time. So less than a third, July the same. Okay, so here's Cameco here. If we take a look at it from an absolute basis, I'm using CCJ, so in the U.S. market. Here we can see that it's really been in this channel here, and we've seen a lot of investors get really excited about Cameco recently and the uranium sector. But really, we've come to the top of this channel, and so we might see a little bit of a pullback. And relative to the S&P 500, it's the same consolidation pattern that's taking place. Back here, we did see it being overbought. And you can see here that after that, it didn't do very much relative to the market. It is overbought right now on both the RSI basis and full stochastic oscillator basis as well. So we could possibly see some weakness. Now, I got to tell you, if there's more announcements or executive orders or big, huge news, we could see the sector continue to go. I really believe that uranium stocks can do really, really well long term. Once that the narrative changes in the market, the focus is still on the growth sectors of the market, AI, technology. But when we see a shift to the commodity sector, I think that's really going to help boost stocks like Cameco, where we'll see a multi-year run. Now, we have seen some strong performance back in 2023, and investors got all excited. That was the time. I think there's a lot of stuff happening at the time for that sector, but it just wasn't enough for it to drive higher. We really need to see commodities in general to move higher overall. I still think the fundamentals are solid, but we could see some sort of softness here. And if we do see a pullback here, this could be good for the start of its next strong seasonal period, which happens to start in September. Okay, I want to talk gold just because it's being talked about in the media a lot. So gold has two strong seasonal periods. The next one starts in July, but it can start in June because there's a lot of volatility around gold. Okay, so I'm going to jump forward here, take a look at gold. So here we are in July. With the commodities in general, you find there's a lot of factors that affect price, and seasonality can be overwhelmed very easily. And we can see them do extremely well, even in the weaker seasonal periods. So you have to watch out for that as well. But here's June, one of the weaker months of the year, but it's not that bad, really. This is from 1984 to 2022. It's on average, it is negative, slightly negative, but given how the dispersion of returns, you can still see large gains in the month of June. But overall, what you do see is this uptick here where we start to see the performance of gold tends to improve really and do extremely well in the month of September. If we take a look here, we can see this is gold. And this is relative to the S&P 500. It's not a fair comparison. One's a commodity, one's a stock market, but just interesting from the returns perspective. Gold has done extremely well for this year, but we have seen this downward trend happening here. And this is typically a flag pattern. Often results in an upside, a breakout here, but we could actually still see some more trending here. It's totally possible. So it's very difficult to tell what can take place here. Sort of at this point, you're waiting for that breakout above the flag pattern, or maybe it's going to come down and bounce once more. But June tends to be volatile, so we could see some opportunities to get into the gold before the start of a strong seasonal period. And I think gold, fundamental, just like I talked about with uranium, has a long-term positive picture, given what's happening in the whole monetary framework. Governments keep spending. We're seeing inflation still being a problem here as well. So we still, it's possible we could see weakness, but I think that would lead to possibly a good seasonal buying opportunity. The month of April was positive. Then we saw a really strong May. And I think this was just a reaction to investors expecting the tariff situation to be resolved so that the tariffs would be really at the terminal rate at a very much lower rate than what they are today. Right now, according to the Yale Budget Lab, the effective U.S. tariff rate is 15.4%. Expectations from investors, the way they're acting in the market, looking really that they're expecting single digits. I'm not convinced that's going to happen. We just saw Trump announce tariffs being doubled for steel and aluminum at the end of May. He's talking about China increasing rates once again. So I think the tariff rates will come down, but I don't think this tariff drama is over here. So the S&P 500 is getting close to where it was before all this tariff stuff happened. And it's possible that the S&P 500 really moved up and overreacted to the upside. There's been a lot of retail participation in this, and this has really been a lot of FOMO. They just don't want to get miss out on the rally, and so they're just piling in, as well as some short squeezing going on. June, on a seasonal basis, tends to be one of the weaker months of the year. In fact, as I mentioned earlier, it's the 9th best month for the S&P 500 since 1950 to 2022, and that's not a solid month. And if we've seen the market become overbought like we have, it's more likely to have a little bit of a pullback here on a technical level. Market is overbought, and we're starting to see some price momentum fading as well. So I do think we'll probably see some softness in June. The good news is that softness could lead to a good buying opportunity for the market. And that would, on a seasonal basis, tends to take place late in June into the mid-July. So that's on the expectations of the earnings season, the Q2 earnings season. The market tends to move up at that time on a seasonal basis. So we could see an opportunity on a positive note later on in the month, but I think we're probably going to see some softness here. I could be wrong. Maybe the market continues to move up, but I think we're going to start to see more reality being built in at this point here for the markets. We'll have to wait and see and watch what happens. It's going to be interesting in the month of June. Thank you very much for joining me today.